Right, let's get more insight with Paul Bloxham, Chief Economist for Australia, New Zealand and Global Commodities at HSBC. Paul, what do you make of these numbers? Does it imply, and what does it mean for February RBA? Does it mean rates are going to be on hold, but they could signal that the next move could be a cut, or is this going to be more akin to a hawkish hold, do you reckon?
I think hawkish hold is still where we're going to be, because I think although we're seeing disinflation, these inflation numbers are coming down, that's what we've been expecting. And as you point out, they're still well above where the RBA's target. And if you drill down into these numbers, and admittedly, these are the monthly numbers, remember, we've got a quarterly CPI in Australia. This is a CPI indicator. It's partial. It's not a complete measure. But you drill down into these numbers, the underlying measure, the trim mean, which is our effective measure of core in Australia, still on this print today was sitting at 4.6%. Now, the RBA themselves are forecasting that the fourth quarter as a whole is going to be at 4.5. So 4.6, it's a touch above the RBA's forecast for 4.5. So it's still telling us that although we're disinflating, we're not disinflating any faster than the RBA was expecting. In fact, if anything, this number's telling us that that's happening slightly slower than the RBA was expecting, and we'll see some confirmation when we get that quarterly print. But what that tells us is the RBA is not going to be particularly, they're going to think this is kind of good that we're heading in the right direction, but we've still got quite a long way to go yet. And so I think they'll still come back into February going, they're not going to lift rates, they'll pause, but still talking about the idea that inflation's still a problem. It's still a challenge. And it's a bigger challenge here than it is in, for example, in the US. I think the US numbers have come down much more quickly, and the factors at work there that are lowering inflation in the US are quite different to what's disinflating us here in Australia. We've still got an inflation challenge, I think, here in Australia.
Yeah, and Paul, I think it's worth remembering in terms of the cycle as well as timing. Australia was sort of late out of the gate in terms of raising rates, and it's also likely to be late out of the gate in terms of cutting as well. Is that fair?
Yeah, I think that's definitely what we've got in mind. So a part of it is that the RBA did less. They didn't lift rates as much. And they've done 425 basis points of tightening compared to a Fed that's gone 525. They did that on purpose, if you remember. They intended to try to deliver a soft landing and intended that inflation would come down more slowly here, and that was acceptable. But all of that implies, of course, that you would expect that they will be one of the last central banks, therefore, to be necessarily cutting interest rates. And then there are other factors as well. We've actually seen in Australia, productivity has been really, really weak, and wages growth has been picking up. So we've got this combination that's driving stronger unit labour cost growth in Australia, more persistence in the underlying inflation measures. In the US, that's improved a lot. Productivity's been lifting, unit labour costs have been coming down. Core inflation in the US is already kind of back to target on a 6-month annualized basis. Here in Australia, that's not the case at all. So I think it's still going to be quite some time. We have in mind that the RBA is not cutting rates this year. We don't think they're going to actually end up having to being able to cut this year.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.